Hi there, welcome back to Dukascopy TV. On this final day of the trading week, I'm Ben Jones. With it being Friday, it's time for your weekly wrap-up, and on the line I have Sant Manukyan from IS Investment to review some of the major events of the week just gone. So Sant, it was a relatively quiet start to the week in terms of data releases, so I'd like to start things off by looking at the German unemployment rate. It stayed at 5.2%, despite a slight drop being expected. Will we see the unemployment rate in Germany fall much lower? And what effect would this have on the euro area?
Even though the unemployment rate is near historic lows, I should mention the increase in the number of unemployment, which was about 24,000. Despite a small number, this was the first increase for the past 6 months. If rates fall much further at some point in the future, we'll see wage inflation, which will put Bundesbank at odds with ECB. A typical problem of the Eurozone actually, meaning Spain and Greece having two-digit unemployment rates and Germany at rock bottom rates. But this is not my base scenario. I believe we have seen the best in Germany and the unemployment rate will head north from now on.
Now yesterday, the US GDP second estimate showed a figure of -1%. Was this in line with anything you were expecting? And what does it show about the current state of the US economy?
No, actually I was expecting about 0.8%, so it's a little bit worse than my expectations. Since the markets are satisfied with the cold weather excuse, we have not and we will not see any reflections. But there is one caveat I should mention. Although personal consumption was revised higher, basically it's utilities, again, due to cold weather, and healthcare. Take those two out, you will see a much weaker consumption number. For the second quarter, I think less than expected change in inventories could give a boost. That's a bright spot in the GDP revision.
Earlier this morning, Japanese inflation data was released. It reached the highest level since 1991, hitting 3.4%. A higher than usual figure was expected, but did you predict anything like this? And what does it mean for Japan?
Again, no, not such a high number, but if you take off the tax effect, the core is 1.5%. It's higher than March, which was about 1.3%, but it's not a shock. It will level out in the near future, and I believe the government as well as the BOG is happy with it. What bothers me is, again, in the details, it's utilities up 6.9%, Medicare up 1.9%, transportation up 3.2%, and wage growth is about 0. I don't think this is the right kind of inflation Japan would be happy to have. So it's a little bit problematic in the near term. Finally, I should say that we will not hear of any QE chatters for the coming months. That's out of the agenda at the moment.
And finally, what would you say is the key event for Dukascopy TV viewers to keep an eye out for next week?
Well, I suppose just like everybody will be watching the ECB and their decision. I'm sure it won't be something huge like quantitative easing. Most probably we'll have a negative deposit rate, which is, I would say, priced in the markets about 10 to 15 basis points. If it's higher than 10 or 15, it will be, again, a surprise, but I don't expect it.
Sant, thank you for joining me once again. That's all from me for this week. Thanks for watching, and tune in again next week for all the updates and exclusive interviews you need. Goodbye.